I want to tell you why, as a 14-year loan officer, I will never use any other loan program in the rest of my borrowing and buying real estate life besides a bank statement loan. See, as a lender, I've been self employed now for over 7 years. It wasn't always that way. I was W 2 up until I found the beautiful world of being a mortgage broker and I became self employed. After becoming self employed and realizing the benefits and everything that comes with writing off a lot of your expenses on your taxes, I was hooked. There's no way I could ever go back to being a W 2 employee. There just couldn't see it happening. But the problem came when I went to buy an investment property. Now, buying that investment property, I had to provide tax returns. And just like everyone would expect, I wrote off a lot. So they came back and said, "You don't make enough money." But I knew I did. I just had to use a bank statement loan. So when you utilize a bank statement loan, we don't even get tax returns. You don't look at anything tax return related. No state taxes, no federal income taxes, nothing. You provide, in most cases, 12 months of bank statements. We then take those bank statements and we add up all deposits over that 12-month time frame. Let's say, for the sake of the video and example here, that over that 12 months, there's $100,000 in income received into that bank account. We take $100,000 and we take out an expense factor. Now, this can vary by industry and job type, but if you look at me or a realtor, for example, we will assume 10% is your expense factor. That's pretty standard for the industry. So if you had $100,000 in deposits, we're going to take out 10% because nobody typically works dollar for dollar straight across without any expenses, which would drop you down to $90,000 on the whole year. We then divide $90,000 by 12 to find our usable income figure. So if you have $90,000 over 12 months, that would be $7,500 a month in usable income. Now, that's far more income than you would have had if you had to provide your tax returns. A lot of times with tax returns, you wouldn't even get approved for a loan based on your write-offs. So a bank statement loan is a very, very easy way to do non-traditional financing without providing any tax returns and getting all the benefits of being self-employed. And you do pay a little bit higher interest rate on a bank statement loan, but not gets points and points higher. It's maybe, let's say, a half a point as an example. That's not a specific. But if it's a half a point higher, you might spend $200 to $300 more per month on interest for your mortgage. However, if you had to reduce your tax write-offs to show more income on paper, you would be spending tens of thousands of dollars depending on your income level to the IRS. It just seems to make sense that you would pay $200 to $300 more a month in interest on your mortgage than you would writing a $10,000+ check to the IRS.